If you own commercial property in Australia, a warehouse, an office, a retail shop, a childcare centre, a motel or a service station, anything other than a home, you're probably leaving tens of thousands of dollars in tax deduction on the table every year. And if it's a bigger property, the number can be hundreds of thousands. Doesn't matter if you have already got a depreciation schedule sitting in a drawer somewhere, or if you never had one done at all. Either way, there is a good chance you're missing money the tax office would happily give you back to you. You just need someone to find it. In the next 15 minutes, I'm going to show you why this happens, what it actually looks like across real Australian commercial properties we have reviewed this year, and how to find out if it's happening on yours. Without paying for a new schedules, without fighting with your accountant, and without any cost upfront. I'm Patrick Chu. I'm the founder of TDQS. We are a specialist commercial quantity surveying practice, and we exist for one reason: to make sure commercial property owners are claiming every dollar they're entitled to. Quick example, before we get into it. These are all real engagements, names we held by mutual agreements, numbers are exact. Case 1, a private Australian investor with a portfolio of shopping centres, offices and childcare centres that had their depreciation schedules done by a long-standing QS firms. We took a look at two of their recent purchases, found a $10.5 million in additional tax deductions. They would have missed $6 million of that hit their first tax return alone. Case 2, a 10-story office building in Sydney. Their schedules has been done by one of the biggest QS firms in the country. The auditor flagged that the numbers looked too low. We rebuilt the original schedules from scratch. The original schedules had captured roughly 33% of what was actually claimable. We tripled their deductions. Case 3, a guy with a portfolio of service stations across Australia. His auditor reviewed 40 depreciation schedules and rejected 35 of them. One single mistake the previous QS made was sitting behind every rejection. We rebuilt all 40 and got the whole portfolio audit ready. Case 4, commercial property owner who held the building for over a decade. Over those years, he spent around $9 million upgrading and maintaining the property. New lighting, new air conditioning, refurbished bathrooms, new lifts. None of it had added to the schedules. The old equipment that got ripped out and replaced was still depreciating on paper as if it was still there. We reset the whole thing and got him claiming every dollar he should have been claiming. Now, why am I leading with all of that? Because I know what most commercial property owners are thinking when something like this lands in their feet. You have already paid for depreciation schedules. Your accountant filed it. Your numbers are on your tax return. Why would you go and pay someone else to look at it? The honest answer is you probably wouldn't, and that's why we don't charge for the review. If you look at your existing schedules and we can't find anything meaningful, we'll tell you it's good schedules. Keep using it. No fees, no our sales pitch. But if you look at it and we find what we usually find, you walk away with the clear numbers in dollars of how much extra you would have been claiming. And typically, the additional deductions we uncover pay for new schedules many times over, often inside a single tax year. If you have never had a depreciation schedule done at all, same offer. We look at your property and tells you what you're entitled to claim. Most owners are genuinely shocked. There are three paths most commercial owners end up on before they find us. I want to walk you through why each one tends to leave money behind. Path 1, the QS who mostly does residential and dabbles in commercials. This is the most common one in Australia. Here is the issue. A residential property has been 20 to 30 individual items. A residential property has maybe 20 to 30 individual items in it that you can claim depreciation on. Things like the oven, the carpet, the air conditioner, and the blinds. A commercial property has 800 to 1,000. The plant equipment is completely different. A residential QS walk in a commercial building and see one big air conditioner. A commercial QS walks in and see a chiller, a cooling tower, two different sets of pumps, a heat exchangers, and a bunch of other components. Each one of these is a separate item with its own claim. If you only see one, you only claim one. 10-story Sydney office I mentioned, the other QS captured 33% of what was there. The other two that wasn't hidden, they just didn't know what they were looking at. Path 2, the big name QS firm reputable, professional, well-known, but the way their model works on commercial property, schedules get done from a template. The capital expenditures you spend each year, the bathroom refurb, the new air conditioning, the lobby refresh, get reported without proper detail. And the item that got replaced and thrown out keep depreciating in the schedule as if they are still in the building. Think of it like buying a new car and forgetting to sell on the old one. You are paying registration on both. That's essentially what happens here every year on every property until someone resets it. Path 3. Your accountant or the accounting software that your accountant uses. Now, your accountant is brilliant at tax returns, but they're not the quantity surveyors. The QS job is to walk through the property, identify every item, value it, put it on a list. Your accountant that takes that list and type the numbers in. Some goes for the software, the Xero or the MYOB, or whichever platform your financing uses. The software does the maths perfectly. The problem is the maths is happening on the wrong numbers. Garbage in, garbage out. A calculator can be most accurate calculator in the world, but if it gives you the wrong numbers to start with, it will confidently produce the wrong number for the next 40 years. 3 different paths, same outcome. Year after year of underclaimed deductions. And those deductions flow directly into your taxable income, your cash flow, and the actual money in your bank account. Here's how I do it differently. And it's structured this way. First, we are commercial only. Every quantity surveyors on our team has worked on commercial property at scale. Office buildings, shopping centers, hotels, industrial estate, service stations, and the lot. We don't do residential because if you split your time between the two, you stop being an expert in either. Second, we give you a full itemized list of every depreciable item in your building. Think of it like a receipt, but for the entire commercial property. Most firms hand you a one-page summary. We hand you a line-by-line breakdown, so when you replace 5 air conditioning units in 2027, we don't just add new ones to the list. We pull the old ones off the list, let you write them off straight away. That immediate write-off in the year you replace them is a real cashback in your pocket. Most schedules miss it entirely. Third, we treat your schedule as something that you should grow with your building, not something you do once and forget about. Commercial property is constantly changing. Bathrooms get refurbished, air conditioning gets upgraded, tenancy gets fitted out. If your schedule doesn't move with the building, you're losing money every single year. And the fourth, every renovation or refurbishment is actually 3 separate tax events, not one. Most schedules only capture one of them. Imagine you renovate your kitchen at home, you buy new appliances, new cabinet and new bench tops. 3 things happen at once. You add the new stuff, you throw out the old stuff, and the kitchen you walk into afterwards is a different kitchen. Most schedules only do step 1, the new stuff. They never write off what you thrown out. They never reset the pictures of what's actually in the building. That alone has been worth 6 figures on one single shopping center's refurb. The reason it's structured this way is simple. Commercial property isn't a one and done asset. It's a living, it's a breathing operation. Your depreciation schedule should work the same way. Here's exactly what you get when you take us up on the free review. First, a 30 minutes call. You walk us through your property and any schedule you already have. If you don't have one yet, no problem. We work off the property details. Second, the gap analysis. We give you a side-by-side what your current schedules has captured versus what you believe is actually there. In plain numbers, no jargons, real items. Third, the dollar number. We put a figure on it. This is what we believe you could be additionally claiming over the remaining life of the property. If we re-prepared the schedules based on your actual property, not a marketing estimate. Fourth, the upgrades and renovation reviews. If you spend money on the property since you bought it, painting, new air conditionings, new lightings, a refurb, we look at what is in your books and tell you what is missing. This is often where the biggest single hit comes from. Fifth, our honest recommendations. Sometimes we'll tell you your asset schedules is fine, keep it, you lost nothing. Sometimes we'll tell you, here is what we prepare schedules would deliver and here is what it would cost. You decide, no pressure either way. And 6, if you do choose to engage us for the new schedules, you also get the options to keep us as your year-on-year updater. Every year, you send us your spending list, we update your schedules, write off whatever you replace, and keep the deductions flowing. I want to call out 2 stories that tends to be the reason commercial owners get bigger results faster than they were expecting. The first is that 10-story Sydney CBD office. The original QS captured roughly a third of what was actually there. When we rebuilt it, we identified more than 10 major plant systems that have needs: air conditioning, building management, fire services, lift, generators, and other facilities. Each one a separate item with its own claim. The schedules produce approximately 3 times the original deductions. Same building, same owner, same tax year, 3 times the deductions. The money was always there. It was just sitting in a schedule that wasn't built to find it. The second is the renovation problem. Take a typical mid-sized shopping center, around $85 million in value, going through a $4.5 million internal refurbishments, new mall lightings, new tilings, food court refresh, new amenities, new mechanical plant. The old QS adds the $4.5 million in new spending to the schedules. Tick, the owner thinks the schedules is up to date. Except all the lightings, all the tilings, all the food court joinery that just got ripped out. None of that gets written off. It keeps depreciating on the paper as if it is still there. That single mistake repeat across one refurbishment typically cost the owner 6 figures in immediate write-off they were entitled to. Multiply that across multiple refurbishments over the whole period and the number adds up fast. A few more, briefly, different scales, different types of properties. A $5 million office fit up. Landlords put in 3, tenants put in 2. We split the deduction between the 2 parties so each one claimed exactly what they paid for. And neither one had any drama if the tax office ever came knocking. A commercial owner who held this property for over a decade, around $9 million in upgrades and maintenance over the years. None of it's properly added to his schedules. We reset everything and got him claiming every dollar he would spend, plus immediate write-offs and everything that has been replaced and thrown out. And on the buyer's agent's side, the agents who bring us in before they buy the property typically improve their client's side after tax returns by between 50 and 100 basis points. In plain English, that's often the difference between winning the deals and losing it. Different scales, different property types, same pattern. The schedules look fine on paper, we found money. So if this sounds like something you want to explore, here's exactly what happens after you apply. Step 1. You filled out the short form below this video. 5 questions, takes about 2 minutes. We ask about the property, whether you've got the schedules already, and the broad numbers. This tells us whether the review is going to be worth your time and ours. Step 2. If you are a fit, you'll be offered a time to book in a 15 minutes call with our team. On that call, we go through the property and your current schedules together so we know exactly what we are looking at. Step 3. You send us whatever you've got, assessing schedules, your spending history on the property, contract of sales if it's recent, email or upload, takes us 10 minutes. If you never had the schedules done, you just send us the property details and we will work off that. Step 4. Within 5 to 7 business days, we deliver the review. We get the gap analysis, the dollar figures, and our owner's recommendation. No obligation to do anything with it. Step 5. If you decide to move forward, we book the site inspections, half a day for a smaller property, up to a week for the bigger ones. Then you get to the new schedules, the full itemized list, and the option for yearly updates from us. That's it. 5 steps. The first 4 are completely free. The 5th is where we will quote you after you've seen the numbers and you decided you want to proceed. The most common thing I hear when I describe this to a commercial owner is, Patrick, I don't have time to deal with another report. I've got tenants, I've got refinancings, I've got my accountant chasing me for the end of financial years. I get it. That's exactly why we structure the review the way we did. The only thing that takes your time is the application form and the 15 minutes call. After that, you send us what you got and we do all the work. The review lands in your inbox within a week. Total time from your end, about 45 minutes. And if there's nothing there, you lost 45 minutes. If there's something there, it's usually 6 figures. In case you're wondering who you're dealing with, my name is Patrick Chu. I founded TDQS in 2022. We are AIQS regulated. That's the global standards body for property professions. And we are registered with the Tax Practitioner Board, the Australian regulator for anyone giving tax advice. Both of those means we're held to the standards and reviewed regularly, which is part of why we are comfortable putting our work up against anyone else. We work on commercial property at every scale, from mid-market warehouses, motels and childcare centres, all the way up to multi-state portfolios with 25 plus assets, premium office towers, service stations networks, and major shopping centres. Some of the names you will recognise, most we can't share publicly because of the value of the deductions involved. 3 other questions that come up a lot. Will I have to fight with my accountants about this? No. We work directly with your accountant. We give them the new schedules, they slot it into the next return. Most accountants are relieved when the numbers improve because it means a better outcome for the client. My property is owned through a trust or my self-managed super fund or a company. Does that change anything? Not for the review. As long as the property is in Australia, we can audit the schedules. The structure questions is for your accountant, not us. I've owned the property for years and have never had a depreciation schedules done. Or I bought it ages ago. Is it too late? This is where most people are wrong. The tax office allows you to amend recent returns under specific conditions. And even where you can't go back, getting the schedule right from this year forward usually delivers the most of the upside. Whether you bought it last year or 10 years ago, it's almost worth a look. So to wrap it up, here is what you get with the TDQS free review. A 30 minutes call, a side-by-side gap analysis of your existing schedules, or from a scratch estimate you have never had one, a dollar figure of how much you could be additionally claiming, a review of spending you've done on the property since you bought it, and our honest recommendation whether that's keep what you have or reprepare it with us. All that is free, no application, no fee unless you have decided to engage us for new schedules after you have seen the numbers. If this sounds like what you've been looking for, the next step is simple. 1. Scroll down underneath this video and fill out the short form. 2. If you are a fit, you'll be offered a time to chat with our team. 3. On that call, we talk through your specific property, your assessing schedules if you have one, and figure out together whether a review is going to be worth doing. Before I let you go, 2 more numbers worth sitting with. Across one private investor's portfolio, just 2 of his properties will recover $10.5 million in additional tax deduction. $6 million of that hit his first tax return alone. Same buildings, same purchase price, same tax year. The only thing that changed was the schedules. On the service station portfolio, 40 depreciation schedules, 35 of them rejected by the auditor. One mistake the previous QS made was sitting behind every single one. We've rebuilt all 40 and the owner now operates from a portfolio he defends if anyone ever looks closely. Whether your property is a $3 million tilt-up warehouse or a $30 million office or a $150 million shopping center, whether you had the schedules done already or you never had one done at all, the pattern is the same. There is almost always money sitting on the table that the tax office is happy to give you back to you. If you want to find out whether that's happening on your property, scroll down, fill out the form. We will be in touch within a couple of business days. We genuinely only tax on reviews where we can see there is likely something there. So if it's not a fit, we tell you upfront. But if it is, this could be the single biggest cash flow improvement you make on the property this year. Without buying anything new, without refinancing, just by making sure that you're claiming what you're already entitled to. Talk soon.